Welcome to this explainer, everyone. Today, we're literally putting on our forensic accounting hats and diving deep into the highly anticipated Gulf Lloyds IPO. Now, whenever a new company hits the market, it's so easy to get swept up in the marketing hype and those flashy headline numbers, but we're going to peel back those layers. We're using the company's own financial data and prospectus to see what's actually going on beneath the surface. It's a fascinating case study in balancing strong industry fundamentals against some very acute, specific risks. Let's jump right in. Here is our roadmap for today. We'll quickly hit on the Gulf Lloyds IPO, look at their niche business model, then we'll uncover the financial growth slowdown, zero in on the 74% risk, explore their supplier dependency, and finally, weigh the final verdict. All right, Section 1, the Gulf Lloyds IPO. Hype meets high stakes. Take a look at this number, 8.19. That is exactly how many times the retail portion of this IPO was oversubscribed during its bidding period. Clearly, there's a ton of initial market hype here. People are eager to get a piece of the action, and demand from everyday individual investors is undeniably strong. But to play in this specific SME arena, you've got to bring some serious capital to the table. The minimum retail investment here is 2 lots, which clocks in at exactly 2,40,000 rupees. Yeah, this isn't your casual pocket change investment. This high barrier to entry immediately sets the tone. The stakes are high, which makes it absolutely crucial that we know exactly what we're buying into. Moving on to Section 2, a niche business model, the business of quality assurance. So what's driving all this investor excitement? Well, Gulf Lloyds operates in the TIC industry, testing, inspection, and certification. Basically, they act as an independent quality verifier. Before massive industrial equipment or infrastructure projects get the green light from government agencies or manufacturers, someone has to verify they meet super strict safety and quality standards. That's Gulf Lloyds' bread and butter. They provide the auditing, the training, and the compliance verification. It's a highly necessary business with serious barriers to entry. And what's genuinely impressive is their footprint across so many diverse sectors. We're talking oil and gas, power, marine, infrastructure, the whole shebang. They've even tackled international assignments in the US, the UK, and the UAE. Honestly, on paper, it paints a picture of a really solid, in-demand company riding some great structural industry tailwinds. But let's pivot to Section 3, the financial growth slowdown, spotting the anomaly. Okay. I want you to play financial detective with me for a second. Looking under the hood at their recent numbers, a different narrative starts to emerge. From fiscal year 24 to 25, you see a totally healthy jump in both total income and profit after tax. But watch what happens between FY25 and FY26. Total income barely budges, inching from 35.88 crore to just 35.97 crore. And profit after tax actually drops from 4.67 crore down to 4.30 crore. Revenues completely stalled and profits dipped. To put that into perspective, that is less than a 1% revenue growth between FY25 and FY26. For a growing SME that's asking investors to pay a 100 rupee per share premium, this flatlining top line is a highly noticeable slowdown. It totally begs the question, why did their growth suddenly hit a brick wall? Which brings us to Section 4, the 74% risk, the elephant in the balance sheet. Here is the culprit behind that financial anomaly. In FY26, a staggering 74% of Gulf Lloyds revenue came from a single customer, just one. Now, for a smaller company in the industrial sector, landing a mega project can easily eclipse all other revenue, but it creates a massive imbalance. Talk about putting all your eggs in one basket, right? If this single client walks away or hits their own financial rough patch, it could absolutely devastate Gulf Lloyds' top and bottom lines. And look, we don't even have to guess how serious this is. We can ground this data in legal reality by quoting the company's own prospectus. They state plainly, the loss of any one or more of our key customers could have a material adverse effect on our business, financial condition, results of operations. They know this concentration risk is there, and they're legally obligated to put it right out in the open for investors. It's honestly hard to miss the irony here. Gulf Lloyds is a TIC firm. Their entire reason for existing is quality assurance, compliance, and risk management for other companies. Yet, right there on their own books, they're carrying this massive, unmitigated concentration risk. It's quite a glaring vulnerability. All right, Section 5, the supplier dependency, the ripple effect. So that concentration risk isn't just hanging out on the revenue side. There's a ripple effect across their operations. Check out their procurement. The share coming from their top 10 third-party service providers is steadily climbing. In FY24, it was around 31%. By FY26, it jumped to nearly 44%. Basically, just as they're relying on one giant customer to bring the cash in, they're increasingly leaning on a shrinking pool of suppliers to actually get the work done. It adds another distinct layer of vulnerability. The real issue is how all these elements stack up. We aren't just looking at one issue in a vacuum. We're looking at compounding SME risks. You've got this intense customer dependency and supplier consolidation pairing up with other stated risks, like a history of weak operating cash flow. That definitely raises concerns about cash conversion. Plus, remember, this is an SME listing. That generally means thinner secondary market liquidity and much higher price volatility compared to your standard main board stocks.
Finally, Section 6, weighing the final verdict, balancing the scales.
Now that we've laid out the facts straight from the source material, let's balance the scales. On one hand, you have some undeniable strengths. They operate in a high-barrier, niche tech industry. They're sitting on a healthy pending order book of over 58 crore rupees. Plus, it's a 100% fresh issue, meaning the cash raise stays in the company for growth and debt reduction, rather than just cashing out the promoters. But on the flip side, those risks are heavy. That acute 74% single customer dependency, the flatlining FY26 revenue, weak cash flows, and those inherent SME liquidity constraints. The margin for error here, it's incredibly slim.
So, what's the big takeaway from this explainer? Well, while the business model is undeniably solid, the financial structure carries some intense, highly specific vulnerabilities. Ultimately, it all boils down to your own risk tolerance. The final question you really have to ask yourself before dropping 2 lakh 40,000 rupees is this: is a 74% concentration risk worth the potential IPO reward? Thanks so much for joining me for this explainer, and definitely go read that full offer document carefully to see if it makes sense for your financial goals.